Hello and welcome to our discussion on the preparation of financial statements. We'll continue to examine the process of converting the business decisions into financial statements. At the same time, we will also understand the difference between accounting profit and tax profits. But the focus of this particular session is to examine the impact of the treatment of employee stock option on the financial statements. In other words, when a company issues stock options, how is that going to be shown or treated in the financial statements? Is ESOP an expense or is ESOP a cash outflow, and what will be the effect on the profit after tax is the focus of this particular discussion. So let us take a balance sheet of an existing company which has the usual items like sources and liabilities, equity and other liabilities, and some assets in the form of plant, stock, debtors and cash. The transactions during the year are given, and one of the transactions is the issue of the stock options. So let us first convert the transactions into the financial statements. So the opening cash in hand is 172,000. Purchase shares with available cash, you have this 172,000. So let us also have a working note here to show the calculations, if any. So the available cash is 172,000. They're purchasing the shares at the price of 20. So the market price of shares is 20. So the number of shares purchased is equal to 172 by 20. So 8,600 shares are purchased. So 8,600 shares are shown as a acquisition of asset, and we show that asset on the balance sheet, and corresponding reduction of cash will happen. Whenever an asset is acquired, that either results in the reduction of cash or creation of a liability or increase in equity, but in this case it's a reduction of cash. So in the cash flow statement we'll show the purchase of shares, purchase of shares 172,000. The annual expenses paid, let me highlight this. Annual expenses paid is 36,000. So expenses, till now we have no income, expense is 36,000, and the payment, and the payment is expenses is 36,000. Maybe we can ask a question, there is no cash, how are you making the payment? So since we don't have cash, so we'll not pay the expense but create an outstanding expenses. The outstanding expense is 36,000 minus payment, so entire expense remains as outstanding. Dividend received 200%. So when we say 200%, the dividend is always calculated on the face value of shares. So face value of the shares is given is 5. So therefore the number of shares 8,500 into the face value. So 43,000 is the face value of the shares. So the dividend is calculated. Dividend, they're getting 200% of the face value. So therefore the dividend is equal to 200% of the capital, and the dividend here is therefore 86,000. So the dividend is an income. Dividend is an income, and we received 86,000, and the dividend is also a cash flow. So let me recap that. The dividend 200%, if nothing specifically mentioned, is calculated on the face value of the share, and the face value of the share is given as 5. The number of shares are 8,600. So the capital of the company which they purchase is 43,000, and so the dividend received is 200% of that. Sold entire stock, and stock means the stock of goods. So sales is 200,000. Sales is 200,000, and that is an income, and sales is for cash, so we show that in the cash flow too. But the corresponding cost of goods sold is 50,000, so the stock will not be there at the end of the year because entire stock sold, no purchase happened. Depreciation for accounting and taxation is 25% on reducing balance method. So depreciation is 0.25 into 80 minus 60. Okay, 80 minus 60, and that is 80 minus 20, that is 60. So the depreciation is 15,000. As a depreciation is not a cash flow but a reduction of asset, so accumulated depreciation goes up to 35,000. Accumulated depreciation is shown on the balance sheet, and depreciation is shown in the income statement, no cash flow. Acquired R&D, you purchase or acquired R&D for business, and for 50,000 paid cash for it, and R&D is an asset. R&D is an asset, so it will appear on the balance sheet as an asset in the year that you have acquired. But R&D has to be amortized, and it says for accounting it is amortized over 4 years. So R&D amortization is divided by 4, that is 12,500 as an expense amortization of R&D, and R&D will reduce to the extent of 12,500. R&D acquired for 50,000 and R&D amortized to the extent of 12,500, but we can see that the amortization for R&D is allowed only from the 3rd year. This is for the year 2. So in the next year R&D will be amortized for taxation. And now comes the issue of ESOPs. ESOPs, 2,000 ESOPs are issued. The exercise price is 70, whereas the market price on the date of issue is 100. So when we said that accounting value of ESOP, the accounting value of ESOP may be the intrinsic value or the fair value. The fair value is determined as per the valuation models, where the intrinsic value is accepted as the excess of the market price over the exercise price. In this case, the market price is 100 and the exercise price is 70, so therefore the value of ESOP per share is 20. Since the company is issued 2000 share, it is 20 into 30, so value of the ESOP for accounting or accounting value of ESOP is 60,000. And what do you do with that? On the date of issue of ESOPs, we create a source as a ESOP payable on the balance sheet on the sources side, and the deferred employee cost on the asset side as a deferred employee cost, 60,000. So find the value of the ESOP as intrinsic value or fair value and show that, recognize that on the asset side and the corresponding sources side, which is in this case is 60,000, 60,000. So let us put that on the balance sheet. So ESOP payable, ESOP payable is 60,000, 60,000, and on the asset side too we show the deferred employee, deferred employee cost, deferred employee cost 60,000. And how did we get this 60,000? So the number of ESOPs is equal to 2000, is equal to 2000. The market value is 100, exercise price is 70, so therefore ESOP accounting value is equal to 60,000, and that 60,000 is shown on the balance sheet as an asset, and the corresponding source is shown as ESOP payable. So this is also a working note for us. And this ESOP, as we mentioned here, is amortized. The deferred employee cost will be amortized over the period, over the vesting period. In this example, the vesting period is 2 years. So therefore, ESOP will be, deferred employee cost will be amortized as 30,000 per year. So we can say that deferred employee cost amortized is 60,000 divided by 2, and the deferred employee expense, which is shown on the balance sheet, will reduce to the extent of 30,000. To recap, whenever there is a ESOP, the value of ESOP is calculated as excess of the market price over the exercise price. So in this case it is 100 minus 70, 30. So therefore the accounting value of ESOP calculated as an intrinsic value is 30 into 2000, and that 60,000 is shown on the balance sheet as ESOP payable and deferred employee cost. And the deferred employee cost is amortized over a period of vesting, and the vesting period is 2, so therefore deferred employee cost of to the extent of 30,000 has been amortized here. That is the treatment of ESOP. Now since almost all expenses are done, let us put the interest. So interest on loan is 12%, and let us assume that interest has been paid. So 6,000 is a cash flow. no other incomes, no other expenses. So the total income is 286,000. The total expenses are 149,500. PBT PBT is equal to PBT is equal to 286 minus 149, so 136,000 is the profit before tax. Now in order to calculate the tax, we need to prepare the tax statement, and the tax statement will not be same as the accounting income statement, because the dividend in this case is not taxable. We'll delete that. So the income is total taxable income is only 200,000. Expenses same as accounting, COGS same as accounting, depreciation same as accounting, R&D in this year no amortization. Generally the deferred employee cost is not allowed as an expense, so the total allowable expenses for computing the taxable income is 107,000. So the taxable profit is 200,000 minus 107, that is 93,000, and assuming the tax rate to be 30%, we get 27,900 is the current tax. So current tax is equal to 27,900, and it has been mentioned that we have not paid the tax, so current tax is equal to 0 in the cash flow. So there will be a liability called CT payable. CT payable, and the CT payable here, 27 minus 0 is a tax payable. And as per the accounting norm or accounting standard, there is a need to show the deferred tax, and the deferred tax, as we have been discussing, it is the tax on the timing difference, and the timing difference arises due to the depreciation, due to amortization. So therefore there is a need for preparing a separate working note to understand what is the deferred tax in this case. So let us create that. So deferred tax, we'll put that here, deferred tax, and deferred tax arising because of depreciation, no change in depreciation, so no deferred tax on depreciation. But there is a depreciation deferred tax coming up in case of amortization, so therefore 0.30 into amortization of R&D in accounting and amortization of R&D for taxation. You can see there is a deferred tax negative, and deferred tax negative means on the balance sheet a corresponding asset to be created. So deferred DTA, and the deferred tax is 3,750 deferred tax asset on the balance sheet. So our income statement is done. Profit after tax is equal to profit before tax minus DT minus CT. So profit after tax is 112,350. If no information is given, we assume that entire profit after tax is transferred to the reserves. Now we can find the cash in hand. The cash in hand is cash available minus the cash payments. So cash in hand is equal to 458 minus 228, So 230 is a cash in hand which will appear on the balance sheet on the asset side. So cash flow statement done, income statement done. We'll now close the balance sheet. No change in the capital, no change in the loan, no change in the outstanding expenses, no change in the creditor. The total of the sources are 568,250. No change in the debtor, and 568,250 is the sources side, and the corresponding asset side is 568,250. So to recap, in this exercise we wanted to understand the impact of ESOP on the financial statement. The impact depends on the value of ESOP, and the value, we take that as an intrinsic value, which is the excess of the market price over the exercise price, and that value is amortized over the vesting period. So in this example, 200,000 ESOPs were issued. The market value was 100, exercise price was 70, so the accounting value is 60. The accounting value is shown on the asset side and the corresponding sources side, and that 60,000 is amortized over the period of the vesting, which is 30,000 each. And there was a tax statement is not same as income statement because of R&D here. So therefore the R&D, which is a timing difference, and that leads to deferred tax, and in this case the deferred tax is negative. In other words, there is a deferred tax asset, and current tax payable is a current liability because we have not paid the tax which is due as per the tax laws. So ESOP will affect the financial statements by appearing on the sources side and the balance sheet. So in the balance sheet, and a corresponding item on the asset side, and the value shown on the asset side, which is called deferred employee cost, is amortized in the income statement. So immediately at the time or in the year of issue of ESOP, there is no cash flow, but there is an effect on the income statement and the corresponding effects on the balance sheet. Thank you very much.